Today, we are going to conduct numerical comparison of investing in Berkshire versus investing in S&P 500. First, let's look at a total return. In his letter to shareholders, Buffett always lists his performance each year, as well as a long-term performance since 1965. And over the past 60 years, S&P 500 performed quite well, increasing 390 times. However, Berkshire increased much higher to 55,000 times. If we convert this to the annualized return, S&P 500 performed decently at 10.4% per year, but Berkshire almost doubled that with 19.9% CAGR over 60-year period. And if we put this on a graph, it is quite clear that Berkshire performed much better than S&P 500 over the past 60 years. Next, we will look at the B-share performance, since this is more reasonable option for individual investors to invest in. In past 28 years, Berkshire outperformed by almost a double. And over the past 10 years, the outperformance gap has narrowed, but it is still outperforming S&P 500, and this is the same in the past 5 years as well as the past 3 years. And year to date in 2025, even though Berkshire fell significantly since Buffett announced his retirement by the end of the year, it is still outperforming S&P 500. So as we saw, Berkshire has outperformed S&P 500 in various periods of time. Now, let's look at the rolling period comparison. Just in case you're not sure what this is, normally we track performance using the beginning and ending data point. So even though Berkshire has 60 years of performance, it comes down to one data point. But if we use rolling periods, for example 10 years, we can create many data sets of 10-year performance comparison between these two to see how Berkshire performed against S&P 500. Let's first look at the 20-year rolling periods. Berkshire generated 13.5% of average return, when S&P generated 10.8%. Not only that, Berkshire outperformed S&P in 90% of periods, so it is a clear winner. However, if you look at the 10-year rolling periods, Berkshire averaged 11.2%, while S&P generated 12.4%. So here, S&P slightly outperformed Berkshire, but even here, Berkshire outperformed S&P over the 60% of periods. The key reason for this is that S&P 500 has outperformed Berkshire for the 10-year periods following the 2008 financial crisis. For example, as we can see here, for the 10-year rolling periods of 21, 22, and 23, Berkshire generated decent returns above 10%. However, S&P 500 outperformed during these periods because lowering market rates as well as the fact that tech stocks have roared quite highly during these periods. Next, moving on to the risk factors, we can divide this into two methods. During these stressful periods, how much S&P 500 fell, as well as how long did it take to recover from its peak before the drawdown. And we can compare this to Berkshire's data. For example, in 2008 financial crisis, S&P 500 fell by 56%, but Berkshire only fell by 53%. And while it took S&P 65 months to recover its recent past peak, Berkshire recovered its past peak in 62 months. So Berkshire fell less and recovered faster than S&P 500. And during the COVID crisis in 2020, market fell by 33%, but Berkshire only fell by 29%. But here, market recovered only in 5 months, while it took 9 months for Berkshire to recover. And during 2022 bear market fell by 25%, while Berkshire fell by 26%. But here, Berkshire recovered much quickly in only 16 months, while it took 2 years for the market to recover. So overall score is that Berkshire wins S&P in this safety score. And if we expand this period to include the IT bubble as well as 2011 European debt crisis, we can see that Berkshire outperformed S&P in most of the periods. Another way to measure risk is looking at the volatility. So here, as we saw before, Berkshire created alpha, but its volatility was less than the S&P 500. So if we combine these data, Berkshire had higher Sharpe ratio, which means Berkshire had less volatility while outperforming S&P 500. Next, we'll look at the sector concentration as well as the overlap between the equity portfolio of Berkshire and S&P 500. First, looking at the sector, as you know already, S&P is heavily invested in the IT sector right now. And if we look at Berkshire's equity portfolio, it is highly concentrated in the financials. However, because for Berkshire, public equity is only a small portion of its overall value, we need to include various businesses that Buffett acquired through M&A over the decades. For example, it has very big energy business, as well as various consumer and retail businesses that we can include here. And if we consider these, Berkshire's exposure to IT and financials even decreased further. So if you compare S&P with Berkshire, S&P is very focused on higher return but higher risk sectors such as IT, consumer discretionary, materials, etc. However, Berkshire is much focused on stable industries such as industrials and utilities. Moving on to concentration, S&P 500 is cap weighted index, so it automatically invests more into bigger companies. In the Magnificent 7 companies, S&P invests 30% of its assets, and its top 10 holdings consists 37% of the index, which is near record high. However, in Berkshire's case, it has active managers, so they can decide which companies they deploy their capital to. But here, the top 10 company concentration is 87%, which is extremely high. But we need to take a step back and realize that Berkshire has other large businesses such as BNSF Railway as well as insurance businesses. So if we consider these, the equity portfolio overall is only 21% of Berkshire's total value. And so it turns out that the top 10 equity holdings is only about 17%, which is much lower than the 37% of the S&P 500. In addition, the market was quite worried that Berkshire has high stakes in Apple. However, recently, Buffett actively sold Apple shares, so its value is now only $64 billion. It's 22% of its equity portfolio, but again, if we consider the overall value of Berkshire, then it is only 6% of Berkshire's overall market cap. So it's actually same as S&P's market weight in the Apple stock. Next, looking at the overlap. If we just look at the public equity portfolio, there is 40% overlap with S&P 500. However, again, if we consider that equity is only 22% of Berkshire's total value, and if we adjust for this number, then the overlap between the two is only 8 to 9%. This indicates that if we invest in Berkshire as well as S&P 500, there is a decent diversification effect. Next, let's look at the capital allocation. Berkshire is well known for not paying any dividends, and S&P 500 pays dividends, but it's only at 1.4%. And in terms of buyback, Berkshire conducts opportunistic buybacks, buying aggressively when the stock is cheap, but not doing any buyback when it's expensive. In terms of S&P 500, it automatically rebalances its portfolio on a quarterly basis, but at the company level, they conduct buybacks. However, these buybacks are semi-automatic, which means they don't really consider whether the stock is cheap or expensive when they conduct the repurchases. What makes it even worse is that when the stocks become very cheap due to the economic uncertainties, most companies temporarily stop buybacks. As we can tell, this is a very bad decision. You should be aggressively buying back shares when it's cheap instead of stopping it. So here we can say that Berkshire is a better option. Next is looking at the cash optionality. Berkshire's cash balance increased very significantly recently. However, this is a long-term trend. And also if we consider the fact that Berkshire has a large float, this cash balance is actually less worrisome. And when the opportunities rise in the market, then Buffett can aggressively invest in stocks or conduct large M&As in a market crisis. So when the next crisis comes, Berkshire has tons of cash to deploy. But on the other side of the coin is that if the crisis doesn't come soon enough, then Berkshire will have to satisfy with just collecting 3 to 5% interest on this cash. So to conclude today's analysis, investors should consider time horizon when they choose to invest in Berkshire or S&P 500. As the time periods gets longer to 10 years and 20 years, Berkshire becomes a better option. And they should also consider taxes. The first factor is that S&P 500 pays dividends and it is growing. So investors have to deal with double taxation in terms of dividends. Also, if you actively buy and sell stocks versus just buying and holding on to Berkshire for decades, the tax difference can be significant. And if we consider other factors, we can summarize that Berkshire is focused on stability of its cash flow, whereas S&P 500 at its current form, with significant money invested in the Magnificent 7 companies, it is highly focused on AI revolution. And as a bonus content, I'll talk about the valuation of these two very quickly. S&P 500 is trading at a very high multiple right now. In fact, it is the highest except for the IT bubble period in the late 1990s. This is why investing gurus like Howard Marks are saying that investors should be careful when they invest in stocks. However, if you look at Berkshire's valuation and its long-term average, we can see that it's not cheap at the moment. However, it's also not extremely expensive compared to its history. And we can also summarize as a table here S&P is trading at about 38 times of its earnings, whereas its long-term median is only 16 times. And Berkshire is trading at 1.58 times of its book value, while its 10-year median is 1.4 times. So there's much more room for S&P to fall versus Berkshire. So that concludes today's analysis, where we've looked at Berkshire versus S&P 500. On our next series, I will focus on Berkshire's business model, which contains insurance, utilities, and equity portfolios. Then we need to take a look at each of them. And afterwards, I will conduct a valuation of those businesses. And in the last video, I will discuss how individual investors can approach Berkshire as well as S&P 500 over a long period of time. Thanks for watching, and if you want to keep up with this analysis, please click the like button and subscribe to the channel. Thanks everyone.